This introductory video guide to your policy will give you a clear understanding of the benefits which this plan offers and the things you have to do so that you get these benefits. Now, let us look at two factors which will be of use to you. Loyalty additions. Starting from the 6th year onwards, we will add 0.4% every year to the fund value. And from the 11th year onwards, the rate increases to 0.6% as our way of thanking customers for continuing to remain invested. What's more, apart from staying invested, if you also pay the premium for that year, you can get an additional 0.25%. Wealth boosters. Starting from the 10th year onwards, we will add 1% to your fund value once every 5 years. For example, if yours is a policy with a term of 30 years, you will get this in the 10th, 15th, 20th, 25th and the 30th year. Loyalty additions and wealth boosters go a long way towards increasing your fund value. Make sure that you pay your premiums and stay invested to receive these benefits. At the end of your policy term, you will receive your fund value as the maturity benefit. You can choose to receive it either as a lump sum or as a regular payout spread over a period of time. Let us take a look at an example to illustrate the benefits of this plan. We will take the example of a healthy 35-year-old male paying an annual premium of 5 lakh rupees for a 20-year period. At the end of 20 years, the maturity value, assuming a 4% investment return scenario, would work out to 1,39,53,102 rupees. And assuming that the fund delivers at an 8% return, this could be 2,19,58,102 rupees. Do note that 4% and 8% are returns used by the life insurance industry in all illustrations. Like in all ULIPs, in this plan, your fund value will depend on the underlying fund performance. The returns are not guaranteed. Instead, they are based on the performance of the funds chosen by you. ICICI Prudential's fund performance is amongst the best in the insurance industry. As of December 2013, majority of our funds have delivered better returns than their benchmarks over a 5-year period. At this point, we would like to reiterate that equity investment should be held for the long term, and the longer you stay invested, the greater will be your potential benefits. An insurance plan is meant to protect you and your family from unforeseen events like death of the main income earner in the family. In this policy, if the person whose life is insured by this policy dies during the policy term, we will pay the insurance amount to the family members. So make sure that there is a nominee mentioned in your policy to whom the insurance amount will be paid. We will assist your family members through a hassle-free claims settlement process to help them get the due amount. One more point. In case of a sudden need of money, you can make partial withdrawals from your fund value. Do note that you will be able to do this only after 5 years of remaining invested. So to wrap up, here is a brief synopsis of your policy. You need to select the premium payment term and the policy term. You can choose amongst 7 different funds to invest in. Loyalty additions and wealth boosters will be added to your fund value if you pay premiums regularly and remain invested. At the end of the policy term, you will receive your fund value. You can choose to get your fund value either as a lump sum or as a regular payout spread over time. If the person whose life is covered in this policy dies anytime during the policy term, an insurance amount will be paid out to the nominee. You can make partial withdrawals from your fund value after 5 years. Pay all your premiums and stay invested for the long term to make the most of your policy.